today to continue on the book, Best in Class. This is chapter 5, Financial Analysis. The quote from Kenichi Ohmae: analysis is the critical starting point of strategic thinking. These are the 45 lessons that I learned. First, financial analysis is a process of evaluating businesses, projects, budgets, and other finance-related transactions to determine my performance and suitability. Second, in multifamily real estate financial analysis, the financial analysis is used to analyze whether a property is stable or profitable enough to warrant an investment. Third, financial analysis is not only required in upfront evaluation of a property, but it also needs to be done on an ongoing basis, like a general maintenance. Fourth, in order to fully understand the health of my business or my property, I must understand the financial analysis side of things. Fifth, if I do not understand this side, I will find making the right decisions regarding the direction of the property tougher. Six, these decisions tend to build on one another and will begin to snowball in the right or the wrong direction. Seventh, financial analysis has a lot to do with digging into the numbers, identifying trends, spotting things that just don't look right. The first thing I need to know is what each financial report represents and how I should be looking at it. Eighth lesson, the balance sheet. The balance sheet is a financial statement that reports a property's assets, liabilities, and capital balance at a specific point in time. Ninth, the balance sheet provides a basis for computing the rates of return and evaluating the property's capital structure. 10th, each of the three segments, which are again the assets, the liabilities, and the capital balance, each of these three segments have many accounts within it that documents the value of each. 11th, accounts such as on the asset side of the balance sheet, these are operating cash, prepaid expenses, accounts receivables, or reserves. So all this account, operating cash, the prepaid expenses, the accounts receivables, and the reserves belong to the asset side of the balance sheet. Now, accounts such as accounts payable, accounts accrued expenses, and long-term debt, these are on the liability side of the balance sheet. Again, these are the liability side, accounts payable, accrued expenses, and long-term debt. 13th, now what is capital balance? Capital balance is the sum of the asset, your asset, my asset, subtracted or minus my liabilities, and therefore I get the capital balance. 14th, the key items to keep an eye on in the balance sheet are the operating cash. Second, the accounts receivable or payable. 15th, accounts payable are money of the property which owes it to its vendors. I owe to pay my vendors for their services. Accounts receivable are the monies owed to the property. So this could be rents. 17, if not properly accounted for and attended to, my balance sheet can become very out of balance, and the property's actual performance can essentially be hidden within these accounts. So this is an example of a balance sheet. Again, it has the assets, it has the liabilities, and it has the capital balance. 18th lesson, the cash flow statement. It makes adjustments to the information recorded in my income statement to show my net cash flow. Net cash flow is a sum of, it's a difference of the income minus or subtracted by our expenses. So income minus expenses gives us the net cash flow. Now, the cash flow statement is the precise amount of money I have on hand for that period, usually for a given month and also year to date. Or it is the amount of money I lost for that time period. 19th, I should break down the cash flow statement a bit further and log into each of the income expense line items to identify anything that seems out of the ordinary. 20th, the cash flow statement is just a summary of each account. I have to go one step further in my analysis. I will need to use the general ledger to dig in a little deeper. 21st, the budget comparison. It compares my actual income, expenses, the net operating income, cash flow, and a lot of other things to my budgeted income and expense. 22nd, the budget comparison allows me to compare areas where the property is exceeding expectations with other areas where I need improvement. 23rd, having something to compare to is always good when analyzing my financial, as it gives me a starting point. 24th, having a budget that is evenly distributed by taking the total and dividing it by 12 months may work once a property is stabilized. Now, if we're doing a value add, I want the budget to be thought out more on a month-over-month basis with a steady increase as I stabilize. 26th lesson. My job, therefore, is to identify areas where the property is struggling and put a plan to get those items fixed. 27th, the 12-month statement, also known as the trailing T12 or T12. My cash flow is for the last 12 months. I will use to identify the negative and the positive trends over time, over the 12 months, since I'm looking at snapshot of the property's performance over the last year, over the 12 months. 28th, when calculating the property's value, T12 net operating income or NOI is often the starting point. So it's the net operating income to determine the property's value, and that is just the starting point. 29th, the general ledger. It represents the record keeping of the property's financial data with debit, credit, account records validated by the trial balance. Now, this general ledger also provides record of each financial transaction that takes place during the life of the property. This is where I dive in and identify exactly where my dollars, where my money is flowing in and flowing out, and where I will need to look to see each transaction. This is where the most details lie I should be looking at if something seems out of the ordinary. I need to spend some time each month in the general ledger to make sure things are properly accounted for. Next is the accounts receivable and accounts payable. Accounts receivable are the balance of money due but not yet paid for by our residents, by the tenants. It is listed on the balance sheet as an asset. So this side here, accounts receivable, is on the asset side. It could be cash or check. So again, accounts receivable are in the asset column. Accounts payable, these are money due to the vendors, to the suppliers, either for goods or for services not yet paid for. On the balance sheets, they are on the liability side. So this is where the accounts payable goes to, the liability side. Much like the cash flow statements, accounts receivable, accounts payables, balance sheets are just a summary. If my balances in these accounts starts to inflate, then I want to keep an eye, a set of eyes on the age report for more detailed look. The aging report will break down what is owed for the current period, 0 to 30 days, 31 to 60, 61 to 90, or more than 90 days. If I am seeing balances that are over 60 days, I need to ask my property management. This could be an issue where the property management is pushing off paying any bills to hide the actual performance of the property. And so they hit their quarterly bonus with their company. 31st, the bank reconciliation statement. The purpose is to detect any discrepancies between accounting records of the property and the bank. Besides, due to the normal timing differences, discrepancies might exist because of error on the property management or error on the bank. Now, I want to make sure that the property management provides the bank statement to me monthly to catch errors, avoid surprises, save money, verify cash flow, prevent fraud. I'm sure I'm asking myself, can I hire a CPA or an accountant to do this? Authors say yes, and they highly encourage. Now, however, the CPA does not know the property like I do, and the CPA will not be able to identify everything that is out of place. The CPA is there as a second set of eyes, and the CPA balance the accounts. But I, the owner, need to be the first set of eyes to make sure everything is in order. Example, the authors found a 10,000 charge for a plumbing expense that was not for their property, and even their manager missed it. Had they not audited their financials on a monthly basis, the authors would be responsible for that expense. 32nd lesson, the property management companies have large portfolios and they manage, and the property manager's accountant are in charge of multiple properties. So there can be mistakes made. And I need to be another set of eyes. I must question the charges that look out of place and unexpected. 33rd, if I am new looking at reports like this, then there's two options. I want someone on my team with this experience. Now, if I cannot afford to hire someone to my team, I, as the owner, need to dedicate my time and energy to learn these reports. 34th, If I am not auditing my financials, I am certainly leaving money on the table. 35th, I should not make the mistake of only looking at line items that are over budget. 36, there have been many times when cash flow statement looked fine, but after digging into the general ledger, they found expenses that were either double charged, coded incorrectly, or not supposed to be there. Everything needs to be lined up for me to get most value for my property. If items are being coded to incorrect accounts, this could have an effect on my buyer's proceeds from the lender. An example of this is 38, the asset management fee. Do I throw the asset management fee on the property management account, or the payroll, or below the NOI line, or the net operating line? Technically, this is not an operating expense. So remember, the asset management fee is not an operating expense of the property and should be below the net operating income line. This way, it does not affect the NOI or any calculations from the lender side. This small change can have a large impact on the value. Example, if the asset management fee is 30,000 per year and calculated at 6% cap rate, so 30,000 divided by 6%, that gives us 500,000 difference in value, 500,000. So it should be below the NOI line. 39th, cash versus accrual accounting method. The main difference is the timing of the revenue and expenses that are recognized. The cash method, it is more immediate recognition of revenue and expenses. Accrual method, it is focused on anticipated revenue and expenses. Example, rent collections. Cash method, tenants pay for their June rent. Now, at the end of the month, the rents accounted for in May, even though the rent is for June, this inflates the revenue for May because your tenant paid at the end of the month of May for their June rent. Now, what it does, it inflates your May and it deflates your June collection. And this is why I will mainly set accrual accounting. So accrual again is anticipated revenue and expenses. 40th lesson or 39th lesson. And this is why, like I said, I will mainly see accrual accounting being used. And this is also a huge factor to consider when underwriting deals such as a T12 or T3, which will likely show larger swings in the cash if the cash method was used. 40th lesson, financial analysis. It is about understanding the overall health of my property and my cash flow position. Without knowing these things, I will be making decisions in the dark. 42nd, when I have this understanding, I can quickly identify and resolve challenges and even take the advantage of potential opportunities. 43rd lesson, one of the main components of being a great asset manager is the ability to shed light on everything so I can make clear, educated decisions. 44th lesson, the first step is educating myself, adding someone to my team who's knowledgeable in financial analysis. 45th lesson, analysis knowledge. I could be costing myself and my investor time and money. And these are the lessons I learned on financial analysis from the book Best in Class.